Welcome back to another episode of Profitless on Purpose, the nonprofit accounting podcast. I'm one of your hosts, AJ Wheeler, and with me, as always, is Mark Palardy.
Hey, everyone.
Got a great show for you. A couple articles and some questions. Our first article is about federal funds for scholars. Should grants and funding for university fellows and tenured professors be easier to get and with fewer strings attached? We'll talk about that. Kind of a salty article, it sounds like. The guy is kind of annoyed that he didn't get funding, but we'll talk about it. And then our second article is the 100% promise right for your nonprofit? When fundraising odes are made that 100% of your donation is going toward programming and not a penny is going to administrative, is that a good kind of marketing strategy for your fundraising at your nonprofit? Does it set you up for failure? Does it alienate your administrative people and make them seem as lesser or non-supportive of the programs? We'll talk about all that and more regarding 100% promise. Very interesting article. And then summer fundraising. If you're if your year ends 12/31, do you have summer time to look at how your fundraising strategies are? Time to think about what different you could do during the year. Now's the time to do it if you have a 12/31. If you're 6/30, you're probably not thinking about that right now. But it's something to think about maybe in winter. We'll talk about what the suggestions are in some of ours if you have time to think about that kind of stuff. And then two questions this week. One on endowment spending, the how, what, when, where, why, and what you can do with your endowment. We'll get into all that, whether there's laws around how much you can spend. We'll talk about endowments, and then investment recommendations for a small nonprofit that has a chunk of money they'd like to set aside. They have operating costs that are covered, and they have some extra cash laying around, and they want to know how to use it. Should they put it in a savings account? Should they invest it in the stock market? Should they put it in a brokerage account? Should they put it in a managed fund by an investment professional? We'll talk about the pros and cons and all that this week. But Mark, you have our first article. Take it away.
Hey, thanks, AJ. Yeah, this one is by Nicholas Tompio, and it's called Federal Funds for Scholars Should Be Generous and with Few Strings. And so this is an interesting article that is kind of reads a little bit like a gripe, but it's interesting still to kind of follow this gentleman's train of thought. And he's talking specifically in this article about the National Endowment for the Humanities and how overall in 2022, they've granted 33.1 million in grants for different programs. But yet for programs that are for scholars, which basically pay a stipend for scholarly work in the nonprofit sector, the amount that has been allocated to that is $600,000 nationally. So that's not a lot of money, to be sure, especially in a national program. And he goes through the process of what it takes to actually apply for one of these programs to do scholarly work on a nonprofit topic. And the crux of his argument is that a lot of work that happens on specific historical or cultural issues happens through this kind of work, especially in areas where you might not be able to get outside nonprofit funding, or you're trying to put a record in place for some sort of historical documentation, and scholarly work is required. But in order to get these kind of scholarly grants, you have to first create a narrative, a work plan, put together your resume, then you have to get your university to submit an application as well, because they can't take too many from the university. So essentially, you're competing with other scholars at your university. Then you have to register with grants.gov. Then you need to get 2 solicited letters from people who have to then affirm this project, et cetera, et cetera. And it's a whole rigmarole, as though you're applying for a grant, which you effectively are. But the bottom line that he's making is that out of the $600,000, you're getting $6,000 before taxes for 2 months of work. So for him, $3,000 a month for this scholarly work, which, if you gross that up, would be $36,000 a year. He feels, based on the level of scholarly work that they're, asserting that they want, just doesn't pencil out. You're not going to get very high qualified candidates. It doesn't make sense to spend all this time and energy to apply for something that you're effectively getting $3,000 a month. I think he makes a good point. I also think the article comes across as a little bit whiny. Um, but it's like this is what is allocated to the National Endowments of Arts and or National Endowment of Humanities. So I don't know that if he wants a different allocation and more money to be going towards scholars, or if he wants fewer of these to be awarded but with higher dollar values. He's not really specific on that part. Basically his thesis is more money, please. So those are kind of my thoughts in Grand. AJ, what do you think?
Yeah, I read this article. I'm like, hello, welcome to applying for government grants 101. Like there are a few extra like loopholes or, hurdles in applying for this specific grant and navigating through a university or a state or national or state university like this that's considered or not, you're under their nonprofit umbrella or whatever. But I mean, what he's talking about is fundamentally changing the way that government grants are administered. And the government has always taken like a one size fits all application process for their grants. Essentially, every grant, whether it's a $2 million, like funding grant for, or entitlement grant or anything, of substantial like dollar amount, or if it's a measly $6,000 or whatever for scholarly research in a university, he's describing the grant application process that any federal or even state and county grants would require somebody to do. You have to submit a budget narrative. You have to submit a budget. You have to then have, some kind of like agreement of what your program is extensively doing. You have to talk with your grantors regarding that. In this case, he has to go through the school board or the board at the school and deem his project worthy of applying for this grant. So I've heard this in the past about, essentially like research at a university and where almost half of their time is spent applying for grants to be able to do the research. And then on top of that, that then reduces the amount of research time that they're able to do. And if they just had a stipend of money, it would make it all more easier. Unfortunately, because of the requirements of federal granting to be able to, equally apply the grants out and be able to make sure that they're funding programs that are earmarked or research that's earmarked as what they want to see happen. The grant process and the grant application for funds like this is required. And again, the government uses this one size fits all kind of mentality. Now, I could see where a board or some kind of trustee at a federal level could distribute these smaller grants without all of this application process and find somebody that has, a research project or has done, has a track record of that. But what that then cuts out are newer researchers that are applying for something that maybe don't have a track record of success, but have like a really cool initiative. So, it cuts both ways. If you're just handing out money, willy-nilly, you're probably relying on somebody that's established and has a track record of providing results, and you wouldn't be able to innovate or have new ideas come to the table. A grant application process like this provides opportunity for somebody that hasn't, established themselves already. But until you change the fundamental one size fits all grant application, this is just the way it is. And you can whine about it all you want, but, and complain about it, which essentially the author is doing. But it's all going to come with strings and some kind of like reporting and some kind of like application process. And, I understand it's pittance for what he considers his work, but I mean, $6,000 to somebody else might seem like a really good, boost to their research budget. So I don't know. I get what he's saying and I understand where he's coming from, but I just don't know that there's much to do about nothing. Essentially, you can't, this is a really fundamental foundation that how government grants are issued.
Yeah. And I think great points, AJ. I think also, are you going to lower the barrier to entry? The cautionary tale here is the PPP funding, right? They lowered the barriers to getting PPP funding so dramatically so that everybody who needed the money could get the money and wasn't stuck in these governmental bureaucratic loops. And now all the stories are coming out about all the fraud that happened, right? So you make money too easy to get on a government level, and it's just like people are out there seeking that to take advantage of it. This is the US of A. If we can get away with something, there are people out there who will try to get away with something. And, I think the dollar amounts are low probably for somebody at his level, but this could also be appealing to people who are just starting their careers, who might be coming out of school, have a great idea for some scholarly research, aren't necessarily well positioned. And it would look great for them if they could get a grant like this, great on a CV and be perfect for them. So, for some of those people, this could be a feature, not a bug, because it might say, well, this money isn't big enough that, a Harvard University professor is going to just snatch up all the grants. It's going to maybe appeal to those who are starting out and be more equitable in some ways because the cost of entry is lower.
Yeah. And I would say, to kind of retort a little bit against that, like a Harvard professor that's like, really in tune with the grant writing process can snap up a lot of these. They have like research staff, some established, like especially a university like Harvard or Stanford or something like that, can really monopolize grant funds because they have such a grant writing machine behind them that, all of their initiatives. I'd like to see some maybe caps put on where the money's going and try to allocate that out a little bit more to different resources, which is probably something that would be achievable as opposed to like burning the whole system down and starting all over again,
Yeah, and it sounds like the system has that within it. That he doesn't specifically mention that, but he kind of talks about how only 2 projects per university are even accepted for review. So that might be an internal cap that the government puts on it, but for him, it's just another hurdle to climb. So on that note, AJ, I think you got our second article for us.
Yeah, I got a really interesting one. So this one, speaking of Stanford, comes from the I can't even speak today. They need to change their name. This is such a tongue twister, but Stanford Social Innovation Review. I'll get it out eventually here. But is the 100% promise right for your nonprofit? And it's by Brian Mittendorf, who is a PhD in CPA that focuses on research regarding financial stability and planning for nonprofits. But essentially what the article is getting at is, I don't know if anybody's been to like a fundraiser where they say all of our donations that come in will be 100% funding programs. And as we have our administrative function covered previously by either direct donations or allocations or whatever. And what this sets up is and what the article proposes is that committing to devote 100% of the of contributions coming into programs risks setting an unrealistic standard, even perpetuating the myth that program spending is inherently better than other spending. And what that kind of sets up, and if you've worked in the nonprofit sector for a while, you know that any of the kind of fundraising metrics or your financial health metrics in any of these, like think GuideStar or Charity Navigator uses, is what percent of all revenue is spent on programs, and then compared to what percent is spent on administrative and overhead cost. Fundraising, accounting is one of those. The executive director salary is considered, a portion at least is considered administrative. And there's all these metrics to measure, and then they extrapolate that onto every dollar that's, let's say it's an 80-20 split. 80% of the money is spent on, programs, 20% is spent on the administrative function. So that means they then extrapolate that and say 80 cents is spent on 80 cents of every dollar that's taken in is spent on programming, 20 cents of every dollar spent on administrative overhead. And people go, oh my God, how is it that much? So I think viewing it that way and trying to match up your donors' priorities with the reality of running a nonprofit is really important. And he kind of makes that focus that funding for non-program costs from a few sources first, and then providing incremental donors a promise that their donations will go directly to programs provides a really good marketing base for fundraising. And I think it really provides, insight into how a donor thinks. They think all of their money is going to the programs there. But what he suggests is shifting the focus from, just programs and administrative to relevant cost. And he provides, and this is something I think that a few our nonprofit audience could benefit from, is thinking about administrative costs. in the beginning of a nonprofit, if you have only a few programs and you start adding more, the administrative burden it's not just a fixed cost, but as you come to scale, that administrative cost begins to become a fixed cost. And so how much you need to cover from an administrative standpoint in the long term, and your programmatic costs kind of follow like a graph here that, of course, as you add more programs, you start to add more costs associated with that. Usually payroll, usually in a nonprofit, the delivery of services is tied to payroll. So those, and, supplies and providing materials and education and blah, 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 anything that supports the program cost is in line with how many programs you're offering, and that cost is incremental. So, so refocusing and trying to have your administrative covered, and then saying that using it as a marketing where any dollars coming in is going to be focused on programmatic things. He's thinking that many donors kind of look at historical data, like we talked about GuideStar or Charity Navigator, on how a charity has used its funds in the past to try and predict future outcomes. And a lot of it, I think, is about, and that's perfectly fine to do, but I think if you look at the way a charity is promising to use the money in the future, I think might be a better marketing or development tool than just relying on past outcomes, and showing donors how their money is going to be used for the future. I think it'd be a much better marketing and securing donations kind of strategy than just relying on all 100% of our donations are now used for that. And so he goes in and he actually sets out that he doesn't think the 100% model is for everybody. The 100% is not a one size fit all approach. In fact, it may only be appropriate for a small amount of charities. So organizations who the 100% model can be helpful are those with a set of donors who can be convinced to provide seed funding to cover administrative cost, high reliance on peer-to-peer or other fundraising practices that make an extended conversation about administrative spending with all donors impractical. Like you have a large donation base and you don't really have a one-on-one. You have a lot of small to mid-sized donations, not a lot of whales and then, really small donors. Clearly trackable program costs, scalable programs. If you don't have scalable programs, that doesn't really apply to you. And then donors who want a clear commitment to future spending practices. Now, if you take that as a whole and look at like who he's hypothesizing this would work for, you have a very mixed model. I have some insight into this, but I'll wait until after Mark gives his 2 cents on it. But he thinks so. He ends the article by saying, seeing that it works for some and not others, those who use the 100% model should avoid increasing an impression that it's a sign of superior virtue or superior fundraising or superior program deployment. Instead, the model reflects a particular fundraising mix and cost structure, one that often can't be replicated by all organizations and especially small nonprofits. When we're talking about having administrative costs covered, you're usually talking about a more robust nonprofit. And so a healthy nonprofit sector has rooms for these different types of organizations to coexist, and for them and for donors not to look like they're choosing a winner, but they're placing their money where it should be placed to try and have the outcomes and social services that nonprofits provide. You're picking a winner based on their services, not on how they're spending their administrative funds, although that can be, into play when you're donating. So, Mark, love to get your input on this. I know we haven't talked about this particular thing between you and I, so I'd love to hear your slant on this and your thoughts.
Yeah, I mean, a couple things come to mind. First, as I'm reading this article, I'm thinking of Admiral Akbar from Star Wars. It's a trap. Right? Because the whole conceit here, right? The big conceit that you've mentioned a couple times is, and he puts it here, seek out and cultivate a subset of donors who are willing to support administrative infrastructure. I'm sorry, this is like the golden goose. Sure, I mean, in a perfect world, we'd all be able to find donors who will 100% support our administrative infrastructure and don't care about supporting programs. But I'm sorry, where do these donors exist, right? Unless you're a really old organization where maybe an endowment covers some of these costs, or there's some other, I don't know that there's a lot of donors out there that are going, I really believe in this mission. I want to buy your copier toner. It's like, there just doesn't seem to be this pool of donors out there, and maybe I'm wrong, that just want to, fund the administrative function. But that being said, I appreciate in the end of the article that he says that donors shouldn't look at an organization, if they can't do this, as ethically inferior to others who can. But that's not really how it works in the real world with donors. If you're sitting at a cocktail party and you have wealthy donors hobnobbing with each other, oh, I donate to such and such, and 100% of my donations go towards the programs, that's going to be appealing to people. And they're not going to say, oh, well, that's because they have the scale and they have this and they have that. And it's a very nuanced way of going about things. And honestly, AJ, as I was reading this, I'm like, this is a marketing gimmick, right? This is like, the realism isn't that the nonprofits don't have administrative costs. It's that they've figured out a way to market this so that they can get more donors in the door who this appeals to. So they are, in a way, sort of saying, we're superior to them because 100% of your money is going to go directly towards programs. I get the appeal here. And I think on maybe a limited basis with some programs, you might say, hey, for this program, we have our nut covered for the year, if you will. For this particular program, we've decided all donations for this fundraising drive are going to go directly to the program. And I can see in a limited way how that can be appealing, and that can really rev up a donor base. Like, oh, I'll give a little extra because I know it's going directly to. But I think as a large scalable model for an organization, it's great if you can do it, but it sets up really unrealistic expectations for donations out in the marketplace. So that's my initial hit.
Yeah, I think I couldn't agree more. I think the elephant in the room that the article doesn't address, and I wish he would have, and it's his kind of research on the financial performance of nonprofit organizations. What he doesn't mention, and what I'm kind of a miffed at, is this all comes back from an internal standpoint. If you're a nonprofit, budgeting and how you cover your administrative costs in your budget. So let's talk about that for a second. With a clear, defined program and administrative budget, you can then start to scheme or understand how you're going to pay for the administrative costs. And there's only two ways: either from admin allocation from grants and contracts, where you assign a percentage of your admin allocation on a monthly basis or yearly basis to cover administrative costs. Or two, the one that's mentioned in the article, is you have donors or some kind of grant covering administrative costs. The problem with those two, so the first one, like to be able to cover all administrative costs through an admin allocation, you're usually only provided 10%. So what you need to do is you need to figure out your administrative costs, and then figure out how much revenue you would need to generate to be able to cover admin by that 10%. So that's what, if we're just taking an A or B kind of thing. Or you need to figure out how you're going to come up with grants and contributions that cover that administrative cost. Those are the only two ways you're going to be able to get it. Or I guess the other third way is what's known as net revenue. So you actually make a profit, like so there's really three ways. So you're providing a service, like a fee for service arrangement, where you're able to charge X amount an hour for something, or you're selling a product or a service at a certain dollar threshold that is more than what it costs your organization to provide. Those types of grants are squirrely to get sometimes. Often, especially governmental agencies want cost reimbursement back in. So that's where that 10% come in. But a fee for service arrangement can be done, and I've seen it be done with net revenue or an positive income at the end of the year. So to take all that into account, what I'm trying to say is I think what's lacking in the nonprofit world that I've never seen, is financial modeling to be able to plan around your administrative costs and how you're going to fund your, often you'll see a nonprofit do a budget, then a budget to actual. They're really looking at like a static type budget, even if it's updated, a static type budget with the historical. I don't see very many nonprofits, and I don't know of very many nonprofits that do a financial planning and analysis to understand how they're going to pay for administrative costs. And if you've ever been on a board or inside a nonprofit, you spend a majority of your time talking about how the hell you're going to how you're going to cover administrative costs. And so I think it's more, we need more focus in this area in nonprofits.
Yeah. And I think, AJ, also a thing to point out that's obvious, right? If I'm doing a program that's 100% donor funded, 100% of your donations get funded, the converse side to that is that program itself is going to have administrative costs. It's not that program itself is administrative costs free. They even talk about this in the article. If there are credit card charges or other things, then you're cannibalizing other programs, or you're having to cover that with some other sort of administrative. So in and of itself, the program of itself is I can't even think of any programs that are administrative cost free, right? That's a fallacy. So making it feel like that this is the way it's going to be for donors. Oh, you can just donate and it's all going to go to the programs. There are administrative costs. There can't not be payroll to even just have staff working on it. Clearly, these things don't run themselves. So
payment of bills, right? Payment of invoices, the administrative burden to make sure that there's an approval, there's an invoice, now we can pay it, that kind of thing. Like,
so those administrative costs go somewhere. So, I'll go back to, it sets up an unrealistic expectations for donors in the marketplace. Oh, I'm going this place and they have no administrative fees, right? And then there's the other bug in the room, right? Which we've just talked administrative and program costs. But if we look at a functional expense report, the other third leg of that triumvirate is fundraising costs, right? And those can fall under administrative, but you got to get the word out that you need these kind of donors. And, there's going to be some significant costs there as well. And, our donors going to think, well, nobody needs to fundraise anymore because,
they got it covered.
It's all covered now. Anyway, so an interesting theory, and I can see why it would be appealing to donors, and I could see why organizations would use it for marketing. But I don't know how many nonprofits out there are actually going to find this a successful model.
Well, and you touched on it a little bit, Mark, but the way that currently we think about nonprofits and like program spending versus administrative spending, administrative is always looked at as like this evil or like, money suck that delivers zero back to the nonprofit or those who serve it. And it couldn't be further from the truth. A well-run administrative. Now, if there are those organizations out there that, like 50% of their program budget is administrative. That's ridiculous. But if we're talking about a 10 to 20% or a 5 to 20% administrative cost, that administration is providing those necessary compliance pieces to your organization that you remain, within guardrails of being able to operate. And like it really is the backbone to be able to run the programs that you're trying to get funded,
Yeah. And people listening to this could definitely think, oh, well, this is coming from a biased perspective. Right. Mark and AJ, who are also known as overhead, right? It's like we're always in the administrative costs. So hey, don't not consider us.
Yeah. But it's true in a way, right? Do you want to devalue what HR does? Do you want to devalue what an executive director does? Do you want to devalue what your accounting department and compliance department does? Those are all really vital pieces of a nonprofit. And if we continue to look at them like they're the enemy of the program, instead of being a propping up and a helping of those administrating those programs, I think that's a much better way to market the way that administrative costs or the administrative arm of an organization does. It really is truly propping up the rest of the organization to make sure that they can function and that they're within compliance, and it needs to be less of an adversarial thing of like, money's just getting dumped into admin, to being successful about running the organization and about providing the support needed to be able to deliver the programs that you're offering, So I'll get off my soapbox on accounting and administrative costs being evil, seen as evil in the nonprofit sphere. But yeah. Really interesting article. Would love to have Brian on the show if he would be willing, Dr. Mittendorf, but we'll see. Stay tuned. But Mark, you got another article for us, don't you?
You bet, AJ. This one's a little lighter compared to our last one. So grab your sunscreen and your Mai Tai, because this one is from Nonprofit Hub, Katie Appold's article. There's a lot to do this summer to successfully fundraise year round. So this is just kind of a light 5 tips kind of an article that we do on occasion, talking about different things that your organization can be doing during the summer to get ready for fundraising. One thing I should mention up front is that I think they're assuming a year-end close, because if you have a 6:30 close, you have plenty to do over the summertime. Anyway, so is summer a good time to fundraise? Well, not a lot of people are giving during the summer, right? Depends on your organization, of course, but a lot of fundraising and giving happens in the 3rd and 4th quarters of the year, especially around Thanksgiving to Christmas. That tends to be a time when a lot of money is coming in. So if you're not going to be out there actually pounding the pavement and asking for money, you can, number one, learn new ways to raise support. So this one I really appreciated, because one of her first points was listen to a podcast. And I would say, if you're listening to this one, score 1 for you, because you've already completed this. But there are other ways, other means and methods you can figure out, to reading books on fundraising, digging into other different things that you might have heard about over the year that you've saved up, and revisit some of those ideas. Number 2, evaluate your vendor relationships, right? You're working with people year round. You want to make sure that your relationships are strong and in place for when you have your big fundraising pushes later in the year. If you need to change out anybody, if you haven't worked with anybody for the first half of the year, make sure they're still active and they can still do with and for you what you need done when it comes time to really start bringing in the funds. Number 3, talk to your teammates about fundraising. I don't know that this should be only during the summer. You probably should at least do this quarterly, right? That if you're a development department, I'm hoping you're not just going like radio silent until the summertime. Oh, we have time now, we can discuss this. But number 4 would be prioritize your connection with donors. Again, probably a good thing to do year round, but summer might be a good way to reach out in different ways and maybe give donors feedback as to how their money from last year has really helped, update people on programs, and really get engaged with your donor base, so that when it comes time for the ask again later in the year, they've recently heard from you and they've seen what their funds did throughout the year. I think that's a great touch point. And then number 5, getting to know your organization by the numbers. This just has to do with reviewing financials and understanding that. I think, again, that's something that's well done anytime during the year. And then, just plan for year end. So a simple list, but some things to kind of jog the memory if you're sitting there during summer saying, I don't know what I should be doing right now. And I don't know anybody who's thinking that, but hey, it could be you. So AJ, your thoughts?
Well, yeah, I have to say, when I was reading this article, I was ready to write it off, because she listed as one of the things you can start doing is learning about TikTok for your nonprofits. And I about just shut the article right then and there. But then I looked at her number 5, get to know your organization by the numbers, and she redeemed herself later on in the article. So I forgive her for her TikTok placement at the beginning, but okay, we can work with this. But one thing I will say is, I think it does reek of organization that has a fiscal year end of 12/31 instead of 6/30. But I would say, from a fundraising standpoint or a development department, who I think this article is really aimed at, one thing that they don't talk about that I think all organizations should take like at least a week to review, their underlying donor platforms. So how you churn your donations, are you using Stripe, are you using whatever that payment fulfillment is, reviewing their terms, how much the percentage of fees they're taking from that, and evaluating whether or not you need to update to a better platform, or if they've changed and you're actually taking in less money, and being able to look at the landscape. That stuff changes regularly. And so just understanding the ins and outs and how much you're paying to be able to get donations in, would be a good thing. And to understand if there's something else out there that would do a better job for you that maybe may be more cost effective. I'm not talking about overhauling your donor platform. I'm not talking about overhauling every year. I'm saying just take a look at it. Like take the temperature on where you sit, and maybe have your financial department look at like what were all the fees that we paid on for our donations last year, and does that line up? Are we paying, could we save, and could we bring in more dollars into the organization by reducing the fees the transactional fees we're paying for individual donation processing? So I think, looking at that stuff and understanding whether or not, your organization is wisely using its fundraising platforms. If there's something more you can learn from those platforms or use them, plugins to your website are usually pretty nifty, where you donate now on your website or something. If you have a fiscal year end of 12/31, this would be a great time to try and implement and test that stuff, maybe while fundraising is down during the summer. Of course, if you're a 630, don't start monkeying with that stuff now while you're trying to get year-end reports out and get, audit prep done and all that stuff, especially from a developmental standpoint, where any development director knows, when audit time comes around, all of a sudden you got to do reconciliations of the GL to try and support the fundraising numbers that are recorded in the accounting system. Don't get me started on all that, but like just take into account that, is there an easier way to do this? Now's kind of the time to look at it, and you don't have to make a decision now, but keep that in the back of your mind when you have time, or if it comes to a point where you need to change those systems.
Yeah, I think, and one more tip that is maybe a little more social and a little less by the books: take your vacations, right? Enjoy your summer. You've probably had a rough fundraising season, and you're going to be gearing up for another fundraising season. So, enjoy some time off too. I think there's nothing wrong with that. And work, and figuring out something to do to fill every niche and corner of time is sometimes not the best for us, for our mental health. So on that note, AJ, why don't we jump into the question or questions this week?
Yeah, I got two. So, and they're kind of related, but so have one question come in. So it's about endowment spending. So recently this question comes from somebody that has just started a new job as an ops manager for a very old organization that has a large endowment. And they have questions around, and they're based out of New York. So they have a UMIFTA from New York that essentially says they're supposed to spend 4 to 7% a year of the endowment, based on a 3-year rolling average of the endowment amount. And anyway, they've received a couple of large donations, and their financial advisor thinks that they should keep it in checking or in a savings or CD because of market conditions right now. And if anybody's checked their retirement savings or their investment accounts, how awful the stock market is right now. But don't get me started on investment strategies and, trying to dollar cost average your stocks in, but that's not my place. But anyway, they wanted guidance on whether or not they can keep the money in checking, or if they need to move it to trust in order to draw down the endowment at the correct rate. And so I have some thoughts on this, but Mark, I'd love to hear your weigh in on this.
Yeah, I mean, I think it largely depends on the amount of your endowment, but I think a strategy that I have seen work well is to not just have your endowment brokerage account, but to also have what's called an insured cash sweep account, where you're earning some interest on the money, better than at a low savings rate, or better than in your checking account, but yet the money is sequestered away so that it's not just in your checking account for others to spend it. I think having separate accounts for endowments are really important, and you don't necessarily need to funnel stuff into your checking account until it's time to spend it. I think, though, in regard to the rules and the guidelines, realize that they're guidelines, right? That the market is going to be volatile. It is possible to spend your endowment down below what it's earning, and then it takes some time for that to come back up to par, if you will. And that happens in a down market. And a lot of this is going to be dictated by what your board says. And the board is going to come up with rates and percentages. Usually your finance committee, if you're large enough to have an endowment, is going to come up with the guidelines as to what percentage the organization wants to draw down. And usually that is updated every year. And you can have draws quarterly, you can have draws, semi-annually. And it often will, if we're in a catastrophic downturn or a recession, if you will, organizations might say, hey, let's slow down on the draw. But those are all funds that get budgeted in and often are needed for operations and needed for specific things. So I think in looking at your drawdown policies for a board, you're playing a little bit of Merlin or trying to prognosticate what's going to happen in the forthcoming year, because this is usually done around budgeting season, because you're usually planning on those drawdown funds being usable to help fund the organization. So I would say, that putting it in the checking account, not so great. But also, as long as you are, you're going to be reporting to your base, and as long as you are using these endowment funds properly, I don't see much of an issue here. So, AJ?
Yeah, I think one thing to note, we're assuming, at least when I read this, we're assuming that those large donations that came in were donor directed to the endowment. If they're not, you don't have a choice of whether or not you put them into the endowment or not. You can't commingle general donation funds. True endowment has to be donor directed, not board directed. And if you can have an endowment that's board directed, but that's called a quasi endowment, and you don't need to follow any rules for that. You just need to report it as such. There's no UMIFTA or New York specific UMIFTA around how a quasi endowment, as it's known, is spent. But let's just assume that the donations are earmarked for true endowment by the donor. There is no, you just need to account for all endowment funds together. So whether you put the endowment funds into a checking account that earn no interest, it doesn't violate endowment rules. It just means that portion of the endowment isn't earning any kind of return, or a very small return if you don't have it in a quote unquote an investment account. And it can be seen as a prudent move, especially in a downturn of the economy where stocks are falling in price and you have it in some kind of investment account that's tied to the general stock market or individual stocks. So I think to keep that in mind, like not commingling funds that are not endowments can get, to be unreasonably unmanageable. You pick the adjective here, but you don't want to commingle funds. So I think that's one thing. But I think the financial advisor has a good point. And I think to be able to spend your endowment, as long as it's on the way the endowment was set up and it's being spent on the way the endowment was directed, you can spend it however you like. You just need board approval on this, and if you're going to dip below the principal, that can be done. You just have to report it and have board approval to do so. So often people think that, this endowment is untouchable and, you can only spend the earnings off of it, but that's just not the case in practice. And the law supports it. When you're talking about that 4 to 7% on the 3-year rolling average, that is a suggestion, a strong suggestion. You should probably, you don't want to have it come out to your donors that somehow you've whittled away your endowment just because you felt like it. They won't donate to your endowment anymore, and it will make your organization look bad. But absolutely, for needed funds, you can dip into the principle of an endowment to be able to steady an organization, or if the board deems it necessary to do so. So I think just keeping all that in mind kind of recenters it, and I think those are things to think about when we're talking endowments. So our next question is kind of related, but investment recommendations for small nonprofits. So this person's on a very small, all volunteer nonprofit, and they have about 150 grand in checking and savings account, and the annual budget for their operations is about 50K. And the board wants to invest a portion in mostly low risk securities. And they're looking for general advice as to what makes sense. And if they should self-manage it or have a brokerage account or have it more actively managed through an investment banker. And the board, they state that the board's pretty savvy with investments, but they have no experience doing it as a 501c3 and aren't sure if any brokerage firms specialize in working with small nonprofits. So, what's your advice, Mark, to somebody that's, has this kind of excess cash, I guess, laying around that wants to put it to use in a nonprofit?
Yeah, I mean, there would be a number of financial discussions you'd want to have. First off, that's not a lot of money, right? I mean, I get that the nonprofit is only $50,000 per year. First off, 50,000 of that should be easily accessible. I would say keep up to a year's worth of reserves of an emergency fund of some sort, because that money can go quickly. And are you looking to expand the nonprofit? There might not be any reason to. This might be just something that you want to keep at this size. But if there's any room for expansion there, I think some of the funds should be used in thinking in that direction. Now, if we get to the topic of investments, that's a tricky one. I think I would suggest using an external broker of some sort or an external company if you're actually going to put money away, primarily for liability reasons, right? Because if you're on the board and you're making financial decisions and some of your financial decisions turn out to be not so great, then it's, it can reflect back on the board. It can reflect back on you personally. And it's, keeping arm's length with some of these financial decisions, I think, is probably the way to go. I mean, you don't have a lot of money to work with, but if you are a growing nonprofit and those funds continue to expand, it wouldn't be a bad idea. Yes, there are definitely brokerage firms that work with nonprofits. The reason I kind of wanted to bring this in with the last one is that, brokerage firms that are dealing with endowments are dealing with nonprofits. They understand low risk. They understand, long-term yields and other things like that they understand the specific way of investing for nonprofits that your financially savvy board might not have all the nuances and all the ins and outs. So I would say that's my feeling in a nutshell.
Golden advice from Mark. Yeah, I would take heed of what Mark said, but I would also think about this. Your nonprofit, you need your investments to reflect the mission and vision of your nonprofit. You don't want to be like an environmental organization and have your organization in the S&P 500 or something, in companies, in oil and gas companies, for instance, or, if you're a nonprofit centered around the elderly, you don't want, your organization funded in something trying to take away Social Security or privatizing it or something like that. So I would say having, whether it's self-managed or whether it is broker managed, one of the unique things around investments with nonprofits is providing that brokerage firm a clear set of paths on what you want to be invested in that is not directly at odds with what your nonprofit is trying to do. So I think, that's something to think about. And I think it's stuff that people don't often consider when they're thinking about reserves and amount. I would say that for this organization in this specific instance, I would recommend that they keep, that, like Mark said, put aside an emergency fund, a reserve fund for $50,000. If that's your annual budget, that will cover you and then some if, funding goes away for these programs that you're using, or if donations are down in a given year. Then what to do with the other, 80,000, because you want to keep, like, let's say 20 grand in cash money for expenses and stuff in the bank. I would say, looking at the market the way it sits today, if you're going to self-manage it, you might be better off just throwing it in CDs and earning a paltry amount of interest on it, and know that the small amount of savings you have is protected and not going through a volatile swings of the market, and having to, people forget when you have even if you just have a brokerage account, but even more so if you have somebody actively managing your portfolio, it costs money in fees. Even if you're in the most basic of financial instruments, an EFT or something like that, then there's fees associated with it, and it can really reduce your earnings by a lot over, don't get me started on compound interest, but compound fees over years can really reduce the yield and the return that you're getting on your money. Not that you're going to get a great return in a CD or a savings account, but at least you're not going to go below your principal. You'll be earning paltry amounts of return on it, but it'll be doing something as opposed to nothing. So
yeah, or even a money market account that's, a little more protected, a little more diversified, something like that could also work. And I mentioned it earlier, but the insured cash sweep is an account that is insured against losses. So you're really earning very little money in there, but it's a nice vehicle if you want to make sure the money is there, but it's also sequestered from the rest of the money. All right, I think that brings us to the end of the episode. This was a great one. I think, again, appreciated our conversation, AJ, and we'd love for you to engage with us. Please send us tweets at Profitless Pod on Twitter. You can always comment below on the YouTube channel. And as always, we really appreciate you being here, and we look forward, on behalf of AJ and myself, we look forward to seeing you next time here on the pod.
Thanks, everybody.